Okay, quick question before we start. If you handed $5 to a kid running a lemonade stand for charity, would you expect the government to look at that and go, nope, doesn't count? Sounds insane, right? Well, buckle up, because that's basically what just happened to millions of Americans, and almost nobody noticed. By the end of this video, you're going to understand a tax change that's quietly costing regular people real money, and you're going to wonder why nobody's talking about it. Let's rewind for a second. For decades, charitable giving in America worked in a pretty simple way. You give money to a cause you care about, your church, a food bank, a GoFundMe for your coworker's surgery, whatever. And when tax season rolls around, you get to write that off. It lowers your taxable income. It's the government basically saying, hey, thanks for being generous. Here's a small thank you. Simple deal. Give money, help people, get a tiny break. Everybody wins. That's how it's worked forever. But buried deep inside a massive new tax overhaul, thousands of pages long, nobody's reading the whole thing, there's a sneaky little rule that quietly flips this whole system on its head. It's called a floor. And no, I don't mean the thing under your feet. Think of it more like a limbo bar at a party, except instead of trying to go under the bar, your donations now have to clear it, jump over it, before any of them start counting for anything. Here's exactly how it works. The government now says your total charitable donations for the year have to add up to at least 0.5%, 0.5% of your income before any of it becomes tax deductible. Sounds tiny, right? 0.5%, who cares? Let's put real numbers on it, because that's where this gets interesting. Say you make $60,000 a year, pretty average salary. 0.5% of that is $300. That means the first $300 you donate this year doesn't count for anything. Zero. Doesn't exist tax-wise. It's like it never left your bank account, at least as far as the IRS is concerned. So think about what that actually means in real life. That $50 you tossed into your neighbor's GoFundMe when their house flooded doesn't count. The $100 you dropped in the collection plate at church last month might not count either. Not unless your total giving for the whole year jumps over that $300 bar first. It's honestly kind of like walking into a store and the cashier telling you, sorry, no discounts unless you spend over this random amount. Except in this case, the store is the IRS, and the discount is money that used to be yours. Now, here's the part that should really make you raise an eyebrow. This change barely touches wealthy donors who make one huge lump sum gift, like someone writing a $50,000 check to a foundation once a year. That one big gift easily clears the floor, so they lose almost nothing. But regular people, the ones who give in small chunks throughout the year, 20 here, 50 there, get hit the hardest because it takes them longer to climb over that bar. And by the time they do, a chunk of their generosity has basically evaporated for tax purposes. Kind of ironic, right? A law that's supposedly about encouraging charitable giving ends up punishing the everyday givers the most, while the big donors barely feel a thing. And here's the kicker. Most people have absolutely no idea this is happening. This isn't the kind of thing that makes headlines. It's tucked away in a huge bill, wrapped in confusing legal language, and most folks are going to find out the hard way, sometime next spring, staring at their tax return, wondering why their refund is smaller than they expected, or why their donations barely moved the needle this year. So what can you actually do about this? A few things worth thinking about. First, if you're someone who gives in small amounts throughout the year, consider bundling your donations. Instead of giving $20 a month to 5 different causes, you might get more tax benefit by consolidating that into fewer, larger gifts that clear the floor faster. Second, keep track of your total giving as the year goes on. Don't just assume every dollar you donate is automatically deductible anymore, because under this new rule, it might not be. And third, if you're serious about maximizing your charitable tax benefit, this is exactly the kind of thing worth a quick conversation with a tax professional, because the old assumptions just don't apply the same way they used to. At the end of the day, this is a perfect example of how a tiny, technical-sounding change buried in a massive law can quietly reach into your wallet without you ever seeing it coming.
It doesn't grab headlines, it doesn't trend on social media, but it adds up, dollar by dollar, donation by donation, especially for people who are just trying to give back in small ways. So next time you're about to donate to something you care about, it might be worth pausing for a second and asking yourself, is this actually going to count? Because under the new rules, it might not. Thanks for watching, and I'll see you in the next video.